The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
The stock rally fades a bit, but the gold rally continues apace. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Scarlett Fu. We're kicking off to the closing bell here in the U.S. And what started off as a solid rally has now faded. The S&P 500 is now on track for its first weekly decline since early September. Financial stocks are the weak link here, although you do have the Magnificent Seven, big tech, keeping the major indexes afloat from falling into the red. 10-year yield and basically across the yield curve, little change, but slightly higher here. The 10-year yield is actually up about 13 basis points on the week. And gold continues to melt higher. It continues to add to its gains, holding near record levels. Romaine?
Yeah, when we talk about those 6 straight weeks of gains on the S&P 500, we're going to need a rally tonight of about 1% or more to pull us to a 7. Doesn't look like we're going to get there because of that meaningful pullback that we've been seeing all week long across the board in broad equity markets, with value stocks bearing the brunt. An S&P basket of value stocks with low price to earnings and book value sliding now for 5 straight days, showing that a lot of the price action that we've seen this week and a lot of the sector rotation, that was defensive at best. And that defensiveness was evident in other asset classes, including in the dollar, which strengthened for a 4th straight week. But something curious is going on. You take a look at bond yields. They also rose this week. So too did gold, to a fresh record high, in fact. Historical correlations, well, they frankly shouldn't have happened. And that breakdown in risk assets and defensive correlations, that's raising some very prominent eyebrows.
What is happening to gold goes well beyond economics and finance, goes well beyond the fluctuations in geopolitics. There's something secular going on.
We've heard similar comments from Ole Hansen over at Saxo, as well as over at Bank of America, Michael Hartnett, and the idea that the record run in gold is more secular, maybe even election related, if you will, rather than economic, actually got some credence today by the latest consumer sentiment numbers out of the University of Michigan. That data showing households growing more upbeat about buying conditions as well as the labor market, Scholar Fu.
Yeah, absolutely. Well, as much as we talk about a broadening of the stock market's rally, growth stocks continue to maintain their edge over value stocks. And that's in large part because the earnings trend still favors tech and other faster growing companies. Now, Tesla's better than expected results this week, just one example. What we're seeing right now is that value stocks, which are the white bars, are making the switch from declining profits in the third quarter to positive growth, allowing them to narrow the earnings gap over time with growth stocks, which are the orange bars. But the bottom line is their bottom line has consistently grown by double-digit percentages, these growth stocks. And value has yet to really close that gap. It's narrowed it, but it hasn't closed it, which makes it harder for investors to have conviction in a durable rotation.
Absolutely, and that's playing out in the price action here on this Friday afternoon as we kick you off to the close. Chuck Lieberman joins us right now. He's co-founder and chief investment officer at Advisors Capital Management. And Chuck, I want to break this conversation up into kind of the short-term moves that we're seeing in the market and some of the long-term outlooks that folks have. And let's start with the short term, because it does seem like a lot of the price action we've been seeing over the past week or so does seem to be tied to election risk and geopolitical risk.
Sure. Well, we clearly have a lot of uncertainty over it. The polls indicate that this is a very, very close election. And some of the Mag 7 stocks have been considered safe havens. So it's not entirely shocking that some people have gone into the Mag 7 to get safety or less volatile performance. But nonetheless, we'll have an election outcome hopefully within a couple of weeks, and then we'll look at fundamentals more closely.
On the basis of that fundamentals, and I'm referring more so to economic fundamentals, if you will, do you anticipate that there will be any sort of meaningful changes in U.S. policy, whether it's fiscal policy, monetary policy, geopolitical policy, if you will, that will have an impact on markets? Or are we just kind of obsessing over all the wrong things?
I don't think it's wrong to obsess about these things, because I'm sure things will change in some in unexpected ways. With regard to monetary policy, the Fed has sort of laid out that it wants to lower interest rates, but it is data dependent, and the data hasn't been accommodative. The numbers recently have been a lot stronger than expected, pretty much across the board. We see the labor market in particular that has performed quite well, especially after the revisions that found a lot of additional jobs. So the Fed was worried about the possibility of the economy petering out. that fear now seems dispelled, in which case, why 50 basis points? That's unlikely. It's not even clear we'll necessarily get 25s at the next two meetings. So I think that changes the story.
It does. And I guess one of the big debates, and I don't expect that it'll get resolved over the next week when we do get jobs data for the month of October, is whether monetary policy is restrictive or not. And to kind of help answer that question, I know you look at what companies are able to do, which is they can continue to borrow in the bond market.
And borrow heavily they have. If you look at overnight rates, those are relatively high or a little high relative to inflation. But in the long end of the market, we're at call it 4% in the 10-year Treasury, with inflation running 2.5 to 3. That implies that 10-year yields are 1.5% at most in real terms. That's below average. That is not restrictive. And we see corporations behaving accordingly. They're spending money. They're refinancing their debt. They're financing investment. Only in the housing market is there still some shock. Obviously, home owners or home buyers are concerned that rates have gone up a lot, and so it's really priced a lot of people out of the housing market. But nonetheless, real rates are not that high.
So given all this, we know that investors are getting ready to position for a big week of earnings and that jobs report I mentioned. Have they already done so, or is it a case of they will react to the news flow when it comes out next week? And then after that, just kind of sit tight until after things are clear from the election?
Well, I think people are going to be buffeted by every single piece of information that comes along down the pike. We don't know what will happen with the election outcome. That's a huge uncertainty. We don't know what will happen with fiscal policy, as Romaine asked. We really don't know. And it's not even clear that either candidate will try to implement all of what they're promising. Right now, we're very much in the middle of the election campaign. They're promising the sky, the moon, and everything else around. And people know better than that. So what will they actually try to push and get through? We have no idea. And then, of course, we don't even know the composition of the House and the Senate. So I think there's a lot of uncertainty. The market will be moved by economic data. And so far, the labor market looks pretty well, awfully well, actually.
Yeah.
And so I don't see the Fed pushing aggressively for rates to the downside. And the market will look at how companies are performing in turn, because on the one hand, higher rates are a big headwind for the market. Yeah. And on the other hand, the strength of the economy means better profits.
Well, we'll keep your economist hat on for a little bit longer here, Chuck. And let's broaden this out beyond just the U.S. borders. There's been a lot of discussion here about the health of the global economy, as well as a lot of questions about the interconnectedness of it. The idea that the globalization that I think you had a front row seat to for most of your career, at least that seems to be fraying on the edges. And I'm wondering if we are going to enter an economic cycle here, a global economic cycle that is going to be a lot more disjointed than in the past.
Well, I think it is going to become increasingly disjointed because the globe is breaking down into trading zones. Russia is a pariah. China and countries that are allied with China are moving to their own drummer or to the drum of Chairman Xi. So things are happening differently in different parts of the world, and there's increased disconnectedness between these different economic regions. And that is going to continue. It'll play out gradually over time. We'll probably have a bit more inflation as a result, but we'll also have more domestic manufacturing and a bit more demand for domestic goods and services across the board. So there are benefits, there are a lot of costs. It's not a great thing that the globe is breaking down in this way. In the short run, however, the U.S. economy is still by far the strongest engine out there. Yeah. We're doing well. We're pulling a lot of countries along. And the ones that aren't coming along, like China, now they're reconsidering some of their policies, and they may implement a lot more stimulus.
All right, Chuck, always a wonderful conversation. Have a great weekend. We'll catch up with you again soon, I'm sure. Chuck Lieberman is the co-founder and chief investment officer at Advisors Capital Management. A lot more coming up here on The Close, including a closer look at Tapestry and Capri. Tapestry shares rallying, Capri shares falling. This after a judge blocked that planned acquisition between the two luxury brands. A discussion here on what that could mean for the American consumer.
Plus, a recipe for disaster as the CDC warns an E. coli outbreak linked to McDonald's burgers is spreading across the U.S. What's next for investors in the Golden Arches?
And a lot of talk about AI, not so much about construction, but how about some talk about AI and construction? We're going to talk with somebody who sees those two worlds converging that could shave months off of pre-construction planning. All that and so much more coming up in a bit. This is The Close on Bloomberg.
Shares of Capri in freefall after a federal judge blocked the company's planned $8.5 billion acquisition by its larger competitor, Tapestry. The deal frozen on the grounds that competition would suffer in this so-called accessible luxury market. Joining us now to discuss this further is Amanda Lewis, a partner at Cuneo Gilbert LaDuca. She was formerly an attorney in the Bureau of Competition for the FTC. Amanda, you had mentioned in your notes that you think the word luxury is a bit of a misnomer here. Can you explain what that means in the context of this decision?
Yes, and thanks for having me. Yeah, I think it's a little bit misleading here because, and the judge addressed this extensively in her opinion. But really, certainly based on my experience, women view handbags as an essential. This is something that women and other people as well, men and women can use handbags, rely on to carry their personal items just day in and day out, to carry medications and wipes and snacks for their kids. So it's absolutely an essential, and you need at least some degree of quality. And so sort of spending money on something that may be deemed an affordable luxury, I don't see it so much as a luxury. I think it's really an essential for many, many consumers across the country. Okay, so the distinction between it's a need to have versus a nice to have. One thing about this trial was that, or hearing, is that a lot of hedge funds, including Millennia Management, Hudson Bay Capital, Balyasny, even David Einhorn's Greenlight Capital, were invested in a position here. They were definitely looking for the decision to go one way. They did attend the hearing or sent their representatives to the hearings. Do you think that had any kind of influence in terms of thinking on the judge's part, or maybe swaying any of her thinking on her part? So if you're asking whether investors being present in the courtroom might have affected the judge's approach or the outcome to the case, absolutely not. I don't think that I've never heard of that, and I don't think that would be the case. I mean, most federal judges are extremely well qualified and very committed to doing their job and getting the right outcome based on the facts in front of them versus who might be in attendance.
So, Amanda, there's a bigger issue, though, here, too. It goes beyond just what the judge's position was, even what the FTC had laid out. And it was really kind of the defense strategy that I think that the company lawyers themselves took. It seemed that there were incriminating things that came out of their own language, meaning the executive's own language here, about their rationale for this merger. And I'm wondering if that didn't come up, this idea that they, at least behind closed doors, seem to admit that this was about tamping down a competitor rather than building themselves into something bigger. If that had not been introduced in, do you think they still would have lost this case?
I do. I actually think there was very strong traditional economic evidence here. Once the judge agreed with the market definition that these two companies, Tapestry and Capri, had combined certainly had a dominant share of the market. So it was not just those ordinary course documents. And in these cases, we refer to evidence like that in those documents as really hot docs. So hot docs certainly help you win the case and tell your story. But this is a case where pretty much all of the evidence pointed in the same direction.
I am curious. I mean, and just drawing on your past experience in the Competition Bureau at the FTC, when you look at the approach that the FTC has taken over the last 3.5 years or so under Lina Khan, do you think that her approach, which has been very aggressive, not just in terms of the actual lawsuits, but really just the idea of casting that pall over anything that's even announced, do you think that that has been a legitimate and successful way of litigating antitrust law?
So I might disagree a little bit with the characterization about sort of casting a pall against or around any merger that might be announced. I think what Chair Cain has done is led a series of robust enforcement actions and made clear that there are no free passes for illegal mergers. I think that her tenure has been very successful. I'm incredibly proud of my former colleagues and what they've accomplished over the past 4 years under her leadership. Have they won every case? No. In my view, I think if you're winning every case, then you are probably not winning enough cases, you're probably not bringing enough cases, and you're only bringing the slam dunks. And I think it is the job of the agency to bring those cases, and then it's the job of the judge to decide what the right outcome is.
All right, Amanda, got to leave it there. Appreciate you taking time for us. Amanda Lewis, a partner over at Cuneo Gilbert and LaDuca, and a former FTC staffer herself in the Competition Bureau. We should point out, Scarlet Fu, Tapestry has said that they plan to appeal this ruling by the judge here. So this certainly isn't over. It doesn't necessarily mean they're walking away from this deal.
Yeah, but it may take a lot longer for it to get resolved. The other interesting part of this, of course,
is it could take shorter, depending on how November 5th shakes out.
Yeah, we've seen Albertsons and Kruger's shares also move in the aftermath of this, because, of course, Kroger's trying to buy Albertsons, and there's a lot of questions about whether this would set a precedent.
Well, that's the thing, too. I mean, and I understand Amanda obviously used to work with a lot of the folks who were involved in this case, so I understand her affinity for some of those folks, but they've lost a lot of cases. And even the cases that they haven't brought, they found the pushback against a lot of these corporations have felt that it was worth fighting. They felt they had a leg to stand on. Whether Tapestry has that kind of muscle, who knows? Albertsons and Kroger certainly think they do.
It certainly dampened potential acquisitions,
yes.
right?
Oh, it did. Oh, yeah. That's without a doubt. I mean, how many people have come on this air and basically said that a lot of things that would have gotten done like this in the past, now it's like, okay, we really got to sit down and talk.
There's a lot of event-driven hedge fund managers who are feeling very frustrated.
Yeah, absolutely here. But like I said, maybe there's a hope and life there for them, depending on how things shake out. We'll see. We continue our coverage, though, here on The Close, and we're going to take a look forward, at some of the moves in the housing space. Shares of Toll Brothers, specifically, potentially creating a great buying opportunity, at least according to our next guest. That's coming up next in our top calls. This is Bloomberg. All right, let's get a view from the sell side with our top calls. The big movers on the back of analyst recommendations, and we start off right now with Denny's, an upgrade to buy over at Citi, which cites progress in the restaurant chain's turnaround story. The analyst checking off at least 3 updates from his turnaround wish list, singling out the company's newfound cost discipline, accelerating store closures, and clearer plans for growth after buying Kiki's Breakfast Cafe. Those shares up for a 3rd straight day. Next up, let's take a look at Apple, a rare sell equivalent rating for the maker of the iPhone. KeyBank downgrading to underweight as expectations for the company to re-accelerate product growth are, in the words of the analysts, unrealistic. Apple earnings out next week. The shares fractionally higher on the day. And finally, let's take a look at Beyond. This is the owner of Overstock and Bed Bath & Beyond. Bank of America cutting its recommendation to underperform in the wake of disappointing quarterly results and an investor event that fueled uncertainty about its turnaround. Skepticism also about Beyond's decision to partner with the Container Store, a retail brand dealing with its own issues. Beyond shares down about 4% on the day, and those are some of our top calls. We do want to stay in the broader housing space right now and turn to one of the biggest home builders out there, Toll Brothers. Wedbush actually lifting its rating to outperform for what the analyst says is a good buying opportunity for the stock. Jay McCanless, Senior Vice President and Equity Research Analyst over at Wedbush, joins us now to talk a little bit more about this. Of course, in a week we are seeing a pretty massive pullback in Toll Brothers shares. In fact, for a lot of the real estate home building stocks out there, what is your general optimism right now surrounding Toll Brothers, Jay?
Yep, and thanks for having me on. If you look at the average toll buyer versus some of the other builders that we cover, we think that luxury-focused buyer has been more resilient, and even some of what Toll calls affordable luxury. They've been able to get those people into homes, and maybe those buyers are a little less payment sensitive than, say, true entry-level buyer would be. And so given their business model and I think their potential kind customers are not as payment focused as an entry level customer might be. We think with the stock pulling back with the move we've seen in rates, we think that does create a good buying opportunity in the name.
Longer term, is there a story to be told for Toll Brothers when it comes to the housing shortage that we have in this nation and some of the policies that could potentially emerge over the next few years to try to accelerate the number of homes and other units on the market?
Yeah, absolutely. I think there's a couple stories. I'd say in the short term, if rates stay where they are or even go up higher as we move into the spring, I think new homes have been taking market share from existing homes. That story could continue. I think that would be good not only for Toll, but also for the group in general, that as people, we've all talked about the lock-in effect where current homeowners don't want to sell because they don't want to give up their 3% or 4% mortgage. That makes new housing more appealing and also makes it less competition for them. So I think that's the near-term potential you could see. And then I think longer term, especially as banks continue to pull back on financing smaller home builders, we think larger names like Toll and Taylor Morrison's the other one we upgraded today. We think names like that probably take more market share inside of new housing just because they do have access to public markets. They can access their credit facilities, et cetera. They can go out and buy the lots and build the homes that maybe some of the smaller, less well capitalized private builders can do.
Do either of these companies that you've upgraded, whether it's Toll or Morrison, are they in a position where they need to buy down mortgage rates?
Yeah, what we've heard from Toll is that they do a small amount of buy downs. And Taylor Morrison, I think on their call, they said about a third of their customers are doing rate buy downs. I think, and with both of them having a small amount of entry level or what we would consider kind of a higher end entry level product, they are still going to have to do some of those, but they've tried, and this is something that Taylor Morrison talked about on their call, is they're trying to steer people into less expensive things like design center options, closing cost assistance. That way you're getting the same incentive dollars to the buyer, but maybe in a less expensive fashion to the builders. But yeah, I think for the industry, I think we're going to continue to see rate buy downs, especially as the 30-year mortgage rate is getting closer every day, especially this week, getting closer every day to 7% again. So I think buy downs are going to be around for a while.
All right. Well, once they've introduced it, it's hard to take it away. Jay McCanless over at Wedbush, thank you so much. Upgrading two of the builders he covers, Toll Brothers and Taylor Morrison. Now, coming up, less than 2 weeks out until the general election, although early voting has begun already, Michael Zezas, head of U.S. Public Policy Research over at Morgan Stanley, will be joining us to talk about each campaign's tax policy. This is The Close on Bloomberg.
Just about 3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostic.
And I'm Scarlett Fu. And when we look at the markets, there's not a whole lot going on at the headline level for the S&P 500. But for the week, you look at treasuries, you look at munis. At one point, munis were on track for their worst week in 2024.
Yeah, I mean, it's still there. Last time I checked, it was going to be the worst week since at least April here. And it gets to this idea of why we're seeing certain things being sold off and other things being bought here, and particularly in the muni space, because you would think that this would, given some of the skittishness in the market, you'd think you would see a little bit more activity there in the secondary.
Well, they're basically following treasuries lower at this point, and yields higher as the economy here in the U.S. doesn't appear to need as many rate cuts as a lot of people had hoped for earlier. And that has kind of caused a rethink, a repricing across the fixed income space.
And if you're an optimist, that's actually a good thing because it means the economy's holding up, blah, blah, soft landing. But everyone just wants more rate cuts more now. Yeah, well, Barclays and JP Morgan are saying now is a good time to consider buying munis, considering the strong market technicals, especially in November and later on this year. Yeah, absolutely. All right, so let's talk about where things stand with 11 days to go before Election Day in the U.S. Experts are going over the candidates' tax policies with a pretty fine-tooth comb. Morgan Stanley says that regardless of the outcome, it expects deficit expansion in 2026, though investors are tilting toward higher deficits in a GOP sweep scenario. And when it comes to munis,
Since we're talking about munis, Morgan Stanley says fiscal expansion won't bring back pre-refunded bonds, but could drive a bear steepener in a way that is ultimately negative for muni excess returns. So as part of our muni moment, we want to welcome Michael Zezas, Managing Director and Head of U.S. Public Policy Research at Morgan Stanley. Michael, good to see you.
Yeah, thanks for having me.
So let's just zoom back a little bit here and talk a little bit about the candidates' tax policies, because on the whole, they're promising a lot of things to potential constituents. What are the tax plans right now? Because I think about what President Trump has promised, and he's promised no taxes on tips or no taxes on expat earnings. It seems like every group gets no taxes.
Paychecks,
exactly.
Yeah. Well, I mean, broad brushstrokes. Okay. Republicans want to limit taxes as much as possible. The main conduit here is the set of expiring tax cuts from the TCJA that expire at the end of 2025.
And that's only the individual taxes that expire, right?
And there's a number of corporate provisions. So the corporate rate wouldn't change if left unchecked, but there are a number of provisions about deductibility that wouldn't extend. And so the Republican plan has been, let's extend everything. And on top of that, Trump has talked about let's not necessarily extend some of the things that would help pay for that. So the implied deficit expansion looks quite large, right? But there's a difference between what you say you can do and what you could get done. Even in a situation where Republicans sweep, we expect that the kind of headline number of extending everything for 10 years, the stuff that like the CBO talks about, that's like $4 or $5 trillion over 10 years, would probably be too big of a number to swallow. You might end up with a kind of shorter term extension of a number of those things. But still, even if you get that number down to like $2 trillion, you're talking about in 2026, a deficit expansion year over year that might be like $300 or $400 billion in that scenario.
And what about the Democrats' proposal?
Yeah, I mean, the main difference with the Democrats' proposal is that they're talking about bringing some revenue to the table, right? So they would only extend about half of those expiring provisions. They'd also like to introduce a new amount of spending, which is an increased child tax credit, but offset it by taking the corporate rate up and a couple of other provisions up. That to us would net out to something maybe like $600 or $700 billion spread over 10 years. But still in that first year, it's still like $200 or $300 billion. So it's still an increase in the deficit, but to a lesser amount. That would probably, though, require a full sweep by the Democrats, and the prediction markets are to be believed that's looking like the smallest possibility amongst all of them.
I mean, how are you guys gaming it out, you and your team over there, particularly when we get to November 5th? I mean, there's the expectations we won't probably know the full results of the election on that night, and it may actually take a few days here. So how are you preparing for that, and what are the kind of the key things that you're going to be keeping an eye on to determine how the race is going to shake out?
I mean, I don't think we have a magic wand or anything. I mean, we're trying to develop situational awareness like everyone else. If the polls are even close to right, this should be a very, very close election that's going to boil down to a handful of states and probably a handful of counties within those states. So we're going to be doing the same thing everyone else is, which is like really tracking vote counts carefully and seeing where they point to develop situational awareness. I don't know if there are specific, that means there are specific trades to do in that kind of, let's say if we follow the 2020 timeline, you more or less know what's happening by the end of the week, so call it the 72 hours. So we're not going to be really focused on telling clients do this or do that in those 72 hours, but expect volatility as markets are trying to sort out what's happening and what the forward policy path is.
Is the market trade too lopsided, though? I mean, so I created two separate baskets, one, the Trump trade stocks and one, the Harris trade stocks, or whatever you want to call it here. The Trump trade stocks clearly outperformed over the last week and a half here. This is a little bit different setup than what we saw during his race in 2016, where he won by as a surprise to a lot of folks who, of course, woke up the next morning and realized they were on the wrong side of that trade.
I think you are starting to see some of these softer market indicators kind of hinting that perhaps there's some higher faith in the idea that Trump could win. I don't know if that means they're pricing in a greater than 50% probability or not, but you're seeing it in the stock market. I think you're seeing it a little bit in the steepness of the yield curve. But to your point, in 2016, even though the polls would have suggested going into it that Trump had a pretty good chance of winning, it still struck as a massive surprise. I don't think it would strike as a massive surprise this time around.
I'm curious what you're going to be doing on election night. How are you going to be looking at what's going on, and what security or asset class do you think will start to move the most or could move the most based on the early results?
Well, I mean, we'll be tracking results like everyone else, and I think the markets that would be particularly attuned to different outcomes would be the Treasury market shape of the curve in particular. Not that we necessarily agree, but I think what most clients are tracking is the idea that the better Republicans do, the steeper the yield curve might be, because you have to kind of balance out the idea that Republicans in the White House might mean more tariffs and kind of growth pressure in the short term, with potentially kind of longer-term deficit expansion either being good for growth or wider deficits and more term premia. So that's something we'll be tracking. We'll be tracking currencies in particular. Yeah. Discussions of tariff on Mexico, for example. Dollar-peso pair has historically been quite sensitive to perceptions of the outcome. That's another indicator to look at.
Would you start looking at chip makers or, any of the companies that are affected by Chinese tariffs, for instance, or tariffs on China, excuse me?
Yeah, I mean, potentially. I think that one's a little harder to kind of disaggregate from the macro environment, but like clean tech stocks in theory might be pretty sensitive to different outcomes because while we don't think that, or we think the bulk of the IRA is probably in place regardless of the outcome, certainly the probability changes if Trump and Republicans do better. And those are stocks that are a little better protected because the money in the IRA is a little bit better protected if Harris wins.
All right, Michael, great stuff here. And I just want to point out, too, we're getting the latest CFTC data crossing the wire here. And now seeing speculative traders flipping to net long the dollar for the first time since August. Michael Zezas over at Morgan Stanley taking a closer look here at the potential policy implications for the market coming out of the election. And of course, both candidates are really campaigning hard right now, Scarlett Fu, and both candidates down in Texas today, obviously a somewhat critical state, not exactly a swing state, but certainly the potential here for some undecided voters. Trump holding a rally earlier today, and then he's scheduled to speak with Joe Rogan.
Yeah, in Austin.
And then Kamala Harris is going to be in Texas a little bit later, and we're told that she's going to get a little bit of a bump from Beyonce.
Some star power there, right? I mean, she already had some star power with Bruce Springsteen. Is Beyonce going
to wear this tonight? Or?
Your guess is as good as mine. You're the one who's seen her in concert, Yeah. But yeah, it's interesting that both of them will be in Texas.
Yeah.
I think most of the American public would be with you.
I have no idea what her economic policies are, but I think she'd be okay.
I think she'd beat them both completely in a landslide. I don't disagree.
But it gets to this idea, too, of how much do these celebrities matter? Obviously, someone like Joe Rogan has a huge amount of influence given how big his podcast is. Beyonce, of course, has a huge following. Does that matter? Is that going to swing people? Because I kind of feel like, to a certain extent, there aren't that many undecided voters. I know we keep talking.
So for the five undecided voters, are they going to decide, I'm going to vote for Harris based on Beyonce performing for her?
Because Beyonce came out or because Joe Rogan said something funny?
No, but people will be entertained.
Joe Rogan hasn't said anything funny for a long time. Did you see his Netflix special that he just had?
No, I don't. Yeah. No, I haven't.
Yeah, he's good on the.
I'm not his target demographic, though.
No, you're not?
No, far from it.
All right. We're going to get back on track here and talk a little bit about some of the big movers of the day, and that includes McDonald's down again for a second day as that E. coli outbreak linked to those onions continues to broaden. It's our stock of the hour, and it's up next. This is The Close on Bloomberg. All right, we're taking a closer look here at shares of McDonald's. It is our stock of the hour. This on the heels of the fallout from the news of that E. coli outbreak in some of their restaurants across 13 states. Now, the CDC has identified 75 cases and said that the number of those infected is likely much higher than what's been reported. Joining us now to discuss is Bloomberg's Isabel Lee, who covers the markets for us here at Bloomberg. And of course, the shares had fallen about 5% on Wednesday, rebounded a little bit yesterday, now sliding again here. How much of the issue right now is McDonald's specific?
So that's the thing. If you ask some people now, they're like, it's not that much lower, it's significantly not 5%, because we still don't know what's happening. It's tied to onions, which is a different story. If it's tied to meat, analysts say it's a bigger deal, because then that means the problem is much more systemic and all that. But then we also have analysts saying that, it's hard to rebound from breakouts like these. And they named Chipotle, which also suffered an E. coli outbreak and norovirus outbreak in 2015. But they also, on one hand, named Wendy's, who suffered the lettuce outbreak. Yeah. And then they said Wendy's rebounded fast. So it really depends on how you respond to the problem.
And how has McDonald's responded to things so far?
They kind of responded fast. On Wednesday, they released a statement saying that they pulled out 1/5 of their burgers from their 13,000 restaurants in the U.S., and I think that's what's calming markets a little bit. And today they keep on updating, but still, we have CDC reporting there are 75 people who were affected by this, and each day it's increasing. It's definitely up from Tuesday, which saw just around 60 plus people. So we still don't know what's happening. Tomorrow we may see more, hopefully not. But that's the thing, it's a developing situation. But you see shares now down around 8% for the week. Yeah. But today just 3%.
Well, this gets to the issue too, because you bring up the Chipotle thing, and I remember that well. And there were a lot of mistakes that Chipotle themselves made that they even admitted to in hindsight. So there is an issue of getting out in front of this, reassuring customers, and then of course trying to reassure investors here that everything is under control. This is a company company that is, in a large part, a supply chain company, right? I mean, they're a food company, but at the end of the day, they're there to source ingredients for all of their franchisees. And they've done a fantastic job of that over the years here. Is there any sense here that if they can articulate a way to get around this issue, ensure that future sourcing of supplies are free of any E. coli or anything else, that will give investors enough confidence to come back into the stock? Or is this going to drag out for months?
I think your first point is really the exact point, because you have its suppliers, Tyson and also Weston. They're down today, but they're also in part helping with this. We have Tyson pulling out some of their stuff. But then to your point, McDonald's is such a behemoth, so all eyes will be on it. They report earnings on Tuesday, and as we know, most of their consumers are low income, and they've been pulling out, which is why you see pulling back when it comes to spending, which is why you see McDonald's.
You said most of their consumers are low. They have some high income. They have at least one high income consumer that we know about.
That is true,
you know.
But in general, that's why they've been putting out deals and discounts, and it remains to be seen whether those are working. But on Tuesday, they will report their numbers, and then we'll see.
All right, Isabel Lee, thank you so much. Isabel, on the latest on McDonald's, again, reminding us that this is a moving story, a developing story. Right now it's a quarter pounder, but Romaine, if it is lettuce, it could be other menu items as well. Hopefully it's not meat, because then we're talking about something beyond McDonald's.
Yeah, and always a reminder here that just really getting to the bottom of these outbreaks is incredibly difficult. It takes a lot of time to figure out where it came from.
All right, next up, we count you down to the closing bells with Ellen Hazen of FL Putnam. This is The Close on Bloomberg.
The market will be moved by economic data. And so far, the labor market looks pretty well, awfully well, actually. And so I don't see the Fed pushing aggressively for rates to the downside. And the market will look at how companies are performing in turn.
A lifetime of wisdom on Wall Street. Chuck Lieberman there kicking us off to the close just about 50 minutes ago as we move closer to the end of the trading week here. And it looks like it is going to be a down week for the major indices, breaking that 6-week long win streak.
Yeah, first weekly decline since early September. Although, if you look at what's going on today, little change. The S&P 500 equal weighted index is lower, which really reinforces how top heavy the gains that we are seeing today are, especially in the Mag 7 names.
And it raises a lot of questions as to what people are moving into. You see the NASDAQ 100 higher on the day. That's the bright spot here. And it's this idea that people gravitate back to
safety.
What is safety effectively, which are the big cash cows of this market. And I guess why wouldn't you?
Yeah, they have the free cash flow. They can do whatever they need to do. I mean, they're kind of these fortresses at this point.
Yeah, we continue to see the VIX elevated on this day. The dollar higher as well. So too is gold, though. Interesting, though, seeing only modest moves in treasuries, and those yields are moving to the upside here. So a bit of selling in the treasury space. We move closer to these closing bells here on this Friday afternoon. Ellen Hazen joins us right now. She is the chief market strategist and portfolio manager at FL Putnam. And Ellen, I do want to talk a little bit maybe about the great rotation that either was or wasn't. Scarlett had the equal weight index up there on the S&P 500, and I was taking a look at the underperformance this week of the Russell 2000 versus the cap-weighted S&P 500. This is like the biggest underperformance we've seen in that space going back to at least the beginning of August, and it raises a question as to what happened to that big small cap cyclical rotation.
That's a really good question, Romaine. The fact is, what's happened is that earnings keep declining for the Russell 2000. So we've been talking about this for a couple of years. There have been 3 or 4 times over the last 2 years where the Russell 2000 or the S&P Small Cap Index has outperformed the Large Cap Index for a month at a time, occasionally 2 months at a time. But the earnings estimates for the Russell 2 just keep going down, while the earnings estimates for the S&P are flat to up. And you just can't have small cap outperformance that's durable as long as estimates are going down. We saw them go up earlier in the summer, the small cap outperformance, but it underperformed in August, September, and then again in October.
So, I mean, what breaks us out of that? Because, I mean, you look at the economic data, and look, I know it's not like, barn-burning economic data, but it's certainly stable. It's certainly better than a lot of people expected. And even if you don't get some wholesale drop in rates, down to 3% or whatever the heck the market was pricing in here, this is still a pretty constructive environment, I would think, for corporate earnings.
Corporate earnings are doing pretty well, but large cap earnings are doing much better than small cap earnings. We all know that, for one thing, the interest rates are more sensitive for small cap companies. In other words, small cap companies have both higher debt and more variable rate debt. And so they are much more impacted by that. And yes, rates are down a little bit with the Fed cutting last month, but not a lot. And the fact is that right now we're in a winner-take-all economy where large companies keep gaining market share, keep consolidating their lead, and small companies are having a tough time keeping up. So between the interest rate environment and the fact that we're in this winner-take-all regime at the moment, I think it's going to be difficult, even though we have that big valuation gap.
Okay, so if we have a winner-take-all regime and big caps have been doing incredibly well, they have the profit growth to back it up, and small caps are struggling, where does that leave investors who want to look out, 12 months in terms of asset class returns? If equities is the only game in town compared to the other asset classes, do you have no choice but to go into big caps?
I think you do. I think that there's a little bit of nuance there, though, Scarlett. I think that you can look at big caps that are within the S&P, but not the Mag 7. So the Mag 7's been doing better lately for sure, but I would much rather own the other 493 than the small cap index. So that's splitting the needle a little bit, but we are looking at broadening out within the big cap index, not just the very largest companies, but still staying away from the smaller cap names. The other broadening out that we're seeing is beyond tech. So again, we go back to earnings. If you look at earnings growth on a year-over-year basis, the first 2 quarters of this year, it was all tech. Tech had the highest growth rate of any of the sectors. And now you're seeing utilities, you're seeing industrials, you're seeing financials, you're seeing healthcare with positive earnings growth, and earnings growth even faster than tech in some cases. And so, again, you can look out beyond the big cap tech to some other areas, but I would stay within the large stocks and not go to the micro caps or the super small caps.
So I'm glad you bring up utilities because they've done incredibly well, keeping pace with technology and in some cases surpassing them. Are the earnings that we're going to be getting over the next few days, few weeks, going to back up that kind of performance?
Utilities have run a lot, and a lot of that has been PE expansion rather than earnings growth. So the earnings growth is there, but we're not seeing the same magnitude of positive earnings revisions that we're seeing in other parts of the market. So I think you can own utilities, and particularly those that are being innovative about using nuclear or other ways to help the hyperscalers with the AI data center build out. So that's where a lot of this growth is coming from, and that's where the multiple expansion is being seen also. So I think there are some you can own, but I think just buying the S&P Utilities ETF might be a little bit risky.
I do want to talk about some of the other holdings that you have, or at least that FL Putnam has, and specifically Netflix. We were talking about them last week, and there was a big surprise, of course, at least for a lot of folks were surprised by the results and the strength in that space. And for folks out there who are looking for exposure to the streaming space going forward here, is there an alternative to Netflix, or is this kind of the best investment in town, if you will?
Netflix is a pretty rich stock, but we still think there's opportunity. Earnings growth is 20% or higher, and that's high quality because it's on revenue growth of 15% or higher. You're seeing strong subscriber growth, and that's coming through. So you've seen multiple expansion up to just over 30 times on the out year. A little rich, but I don't think anyone else is coming close. Right now, a lot of the other media companies are really battling for second, third, fourth place. I don't know that they're going to make it. They have some cash for now to keep plowing into content creation and promotion and customer acquisition costs. But I do think Netflix is the one to own. And I think the thing to do is to try to be opportunistic, have it on your shopping list, buy a little bit now and buy more if there's a correction of some sort.
Ellen, going to leave it there. Ellen Hazen, Chief Market Strategist and Portfolio Manager at FL Putnam, counting us down to the closing bells here on this Friday afternoon. Just about 2.5 minutes or so away from there, and stocks are now well off the session highs here. Again, once again, the only real bright spots you're going to find in the NASDAQ indices.
Yeah, absolutely. Treasuries are also declining once again, pushing yields higher. And this is something you pointed out at the top of the hour, which I think is really interesting, how gold prices are rising, as is the U.S. dollar, which, kind of goes against the grain.
Yeah, and I think, too, I mean, if you go back and listen to that interview that Mohammed El-Arian gave a little earlier, this is kind of concerning to see those correlations break down.
Right.
The problem is nobody seems to know exactly what it means, but a lot of it does seem to be tied to this idea of election risk and people positioning around what they think the outcome is going to be. We are positioning around the outcome of these markets on the day and on the week. Our full coverage of all that, it starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Scarlett Fu. We're taking you to the closing bell with a global simulcast that starts right now. Carol Massar and Tim Stenovic joining us from the radio booth as we welcome our audiences across all of our Bloomberg platforms, including our partnership with YouTube. As the week peters out here, Carol Massar, coming off 6 straight weeks of gains here for the broad market. There won't be a 7th. I'm not sure if that's a bad thing. Maybe we just need a bit of a reset.
Maybe we needed a bit of a reset. Well, first of all, happy Friday to everybody. I'm looking at the stocks, though.
Did you get some macaroni bites earlier today?
Excuse me? No, were there some in...
They were on air.
Oh.
What?
Oh, yeah. That's right. When you guys go on air, too, they just roll out all the great food.
Yeah, they missed it.
We know.
Thanks, Scarlett and Romaine, for bringing us up.
Sorry for bringing it up.
Okay. I'm looking at the stocks, guys. It's actually doing some outperformance here. I'll tell you why when I get to my gainers, but it's up about 1%. You've got 27
That's a deep tease, everyone.
of the 30 names in the stocks are higher today. Yes, indeed.
I'm watching what's going on with crypto because we're actually seeing Bitcoin down about 2% right now. Just after we went live at about 2 o'clock today, the Wall Street Journal reported that federal investigators are probing the cryptocurrency firm Tether. Kind of sent some shivers throughout the industry today.
I feel like everything we're seeing right now is just positioning for the next 2 weeks. You've got a big week of earnings. You've got a big jobs report. Then you've got the early voting beginning already and the election the following Tuesday. There is a CFTC positioning update that Romaine broke earlier talking about how traders are flipping back to long dollars at a time when gold continues to make new highs.
Yeah, absolutely. Here, I mean, when you talk about event risk, I think these next 2 to 3 weeks are really going to be chock full of it. Of course, with those earnings, Scarlett was referring to the election, and don't forget a Fed meeting right on the heels of that. Throw in the mix, of course, a jobs report and everything else. Woo! All right, let's wrap up this week, though.
Wait, is that a who?
It was a woo, but slightly different. Forbes are ringing the bell there at the NYSE, and can't really see who that is over at the NASDAQ, but you can see the NASDAQ composite. That is your bright spot on the day, up about 0.6%. The S&P 500, we're going to call it unchanged on the day, though decidedly down on the week. The Dow Jones Industrial Average down 0.6% on the day, also down on the week, and the Russell 2000 closing out this Friday down by 0.5%.
Guys, want to guess what the number one gainer is in the S&P 500 this week? Do not cheat.
For the week?
Yeah, for the week.
Tesla.
Nice job, up 22%. Well done.
No cheating.
Well done.
No. It's just, it was just an outsized gain the other day. So.
Yeah, okay. Genuine Parts is the worst performer, down about 20%. S&P 500, guys, today, 150 names to the upside, about 350 to the downside today.
All right, let's take a look at the sector performances here. It's a real split, although definitely tilted to the downside. Your worst performers are utilities, and of course, they've been on a roll because of the AI play. That group is down 1.5%. Financials losing ground by 1.1%. I know that Tim's going to talk about the New York Community Bank being one reason why. Consumer staples losing 0.75%. And on the flip side, communication services, tech, and consumer discretionary, which is like home to all those big tech names, they're up.
All right, so a mixture of red and green. All right, let's get to some of the individual gainers. Got to say that there was a lot more outperformance earlier in the session. NVIDIA, for example, was up about 2.6% at its highs today, finishing the day with a gain of about 0.8%. B of A Securities out, pounding the table for a portfolio of AI chip stocks, citing a generational capex cycle in generative AI infrastructure. The analyst over there, Vivek Arya, saying his top picks are NVIDIA and Broadcom. So we did see NVIDIA a little bit of a pop in today's session. Tapestry, number one gainer in the S&P 500 today. This one up 13.5%. We know this story, right? We were talking about it yesterday. This one soaring, got the news after the close, after a federal judge yesterday blocked Tapestry's planned $8.5 billion acquisition of Capri Holdings, citing harm to competition in the accessible luxury handbag market. So you did see investors happy that this deal may not happen. One more, Deckers. We talked about this too. After the close, some earnings coming out, finishing with a gain of more than 10%. It, too, was a top gainer in the S&P 500. Company posted second quarter net sales that beat the average analyst estimate, and it also boosted its sales forecast for the full year. That stock, by the way, up 51% year to date.
Why does Tapestry not just go by Coach or Kate Spade or Deckers by UGG?
And somebody said even Burberry. I think we had a Bloomberg opinion column by Andrea Falstad who said maybe they should go after Burberry or something.
If the FTC will allow it.
Yeah, well, we'll see.
Yeah.
Can I just put
To be
honorable
continued.
mention on your board, Carol Masser?
You know, I kept it to 3 because I know you don't like when I do 4. So I don't
All right,
know
we'll
if
just
you
move
could
on.
do-
Go ahead, Romaine.
Go ahead.
I was going to say there was a phenomenal move earlier today in Newell Brands, which was up about 20% on the back of their earnings report this morning here. Kind of a potential turnaround story there.
Because I like you, yes, you can do
Yeah,
it.
thank you. That's like, you know those big Rubbermaid things,
Got a
The
lot of Rubbermaid
containers.
at home. Yep.
I think you would have those on your boat, right?
All right, let's
Moving
go
on.
to some of the decliners. I do want to go back to McDonald's. Shares fell again after the CDC said that outbreak of E. coli linked to McDonald's burgers has infected 75 people in 13 states. Shares fell another 2% today, close to 3%. The CDC said the risk to public is very low due to the actions taken by McDonald's and the onion supplier Taylor Farms. Here's what the CDC said. The true number of sick people in this outbreak is likely much higher than the number reported, and the outbreak may not be limited to the states with known illnesses. As a reminder, 22 people have been hospitalized. 2 people have developed hemolytic uremic syndrome. It's a serious condition that can cause kidney failure. Let's take a look at Capri Holdings. Shares just plunged today. This after the federal judge late yesterday blocked the company's planned $8.5 billion acquisition by Tapestry, the maker of Coach and Kate Spade handbags. Shares fell close to 50% today. And then finally, New York Community Bank Corp shares fell after the company provided guidance for net interest income and earnings per share for 2024 and 2025 below Wall Street expectations. The company also recorded higher than expected provisions for credit losses in the third quarter. Shares ended up falling today by more than 8%.
All right, let's take a quick look at yields here. On the day, you did see a modest increase in yields going higher here on the day. We can just take a quick look there, up about 2 basis points on the short end. You're up at 4.1. We should point out there's been 5 straight days now where we've seen that 2-year yield drift higher here. The 10-year yield also drifting higher here, 3 basis points on the day, but on the week, up about 15 basis points on the week. In fact, that's one of the biggest weekly moves higher in yields that we've seen in the last couple of months.
All right, guys, I've got a question for you, a story on our radar, courtesy of the New York Times, and I have a question for you. Are you gate lice?
That sounds really gross, Carol.
Well, it's actually, you know, those folks, the zones are called Zone 1, Zone 2, and they're really Zone 3 or 4, but nonetheless, they cut the line and they go up and they try to get on early. Well, American seems to maybe have a solution for that.
Yeah, so what they're going to do, which I'm surprised that they don't already do this across airlines, but what they're going to do is when a passenger tries to board the plane early and they're not in that group that's been called, this new system will give an audible signal to the gate agent. That's according to the airline.
Gate shaming.
Gate shaming, maybe a very loud one that lets everybody know all around them that they were in the wrong line.
I don't know. Some people you just can't shame.
True story. Carol and I were flying to LA just a couple weeks ago.
Are you going to embarrass him?
No. Do you remember we were in line waiting and that guy cut in
yes.
front of us and
Cut in front of me. I was talking to you.
Yeah, he
my
cut in
back
front
was
of you.
turned.
And he went through, and the gate agent totally let him through. But there was another guy in line who was with us who was just so enraged by this and just doing everything he could to control himself.
And I wanted to say something, and he said, no,
Yeah,
don't
he
do
said,
it.
don't say
Just leave
anything.
it. Just leave it. Yeah. Well, I mean, now
I
you would wait
said,
for
"Don't
this
embarrass me,
this
Carol."
beep to come through, and I don't know if a guy like that would have made a difference, right? He would have been like, I'm already through. Doesn't matter. I don't care.
Do you follow the line, right, Romaine?
Yeah, well, usually I'm in Zone 1, not to brag.
There it is.
Okay, so not an issue for Romaine. The other story that we're keeping an eye on, this is wacky, right? Silicon Valley entrepreneurs, they're investing in SRM, solar radiation management. It's a way to cool the Earth by reflecting sunlight to cool the planet. Yeah, you know how when volcanoes explode, the ashes...
No, I don't actually.
Well, when they do, ashes cover the sky and it cools down the temperature on Earth.
And so they decided to do this artificially?
Kind of, yeah.
Okay, I'm pretty sure I saw a James Bond movie that had this exact same plot and it did not end well. What's the longer term purpose of this?
To slow climate change, basically, to slow global warming.
Okay, all right.
I
know nothing, as you know, I know nothing about Earth science, so maybe this works. But I don't know. I always feel like once human beings start meddling in this stuff, it never really goes the way we intend.
Well, during the Beijing Olympics, didn't they see the clouds to make sure that there wasn't any rain? So they've already done things like this.
Yeah,
or some countries have done things like
yeah,
this.
and the Saudis tried that too, and you saw exactly what happened over there early this year with all that flooding. So, I mean, it's like, I don't know. I mean, I guess if you get it right, great, but am I supposed to trust in the Silicon Valley Bros?
Well, that's
to
the
get this
thing,
right?
Their mantra is,
I mean,
move fast and break things.
No offense to all the Silicon Valley Bros, but, there's a reason why they call you Silicon Valley Bros.
No comments, Tim?
I'm just letting Romain
Hey, listen,
go.
there is money, though, that's going to it.
I'm just letting him go.
Just letting him go. It's my strategy here.
It might be pretty soon, Tim.
All right. Who knows? Who knows where it'll all
By
go?
the way, before we go, shout out. Phil Lesh died today.
Oh.
Great base. Carol, you have no idea.
Matt Miller will be very
basis
upset
over
about
at
this.
the Grateful Dead here. Basically, the counterpoint to Jerry
Do you know
Garcia.
what? I think my first.
He was 84. By the way,
one of
so
my
he
first
lived a lot.
concerts was the Grateful Dead.
Really? Oh.
Yep.
What was your first
My
concert?
brother was a mega Deadhead and took
Was
me
it?
and my best friend.
Wait, everyone name your first concert. Because I'm curious what
Mine
made
was
this.
Stevie Wonder.
Ooh,
It's
good
pretty
one.
good. Mine was Toad the Wet Sprocket.
Wow.
Mine was Genesis, strangely.
Okay.
So this is a good icebreaker if we didn't all know
Now
each
we know
other.
how
This is what
old
you're
each
supposed
one
to
of
do.
us
I know.
Based on our responses. Bye-bye.
I'm a little hurt. I'm just going to say.
Time to wrap.
All right, that is a wrap. Our
Okay.
cross-platform coverage, radio, TV, YouTube, Bloomberg Originals. Have a good and safe weekend, you guys. All right, we will see you again, same time, same place, come Monday.
All right, it is still Friday, and with fresh data out this week showing new home sales jumping to more than a one-year high, we look at the affordability of housing. Eric Van Nostrand, the chief economist over at the Treasury Department, he'll be joining us in just a few minutes, right here on The Close on Bloomberg.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Romain Bostic. Looks like we did survive the week, though markets, well, maybe they were hoping for something a little bit better. But we did have 6 straight weeks of gains. 6 straight weeks of gains for the S&P 500. That ended this week, a 1% drop on the S&P on a weekly basis. It could have been a lot worse. And we should point out that the price action really was more of a rotation than a sell-off. Unfortunately, a lot of the things being rotated out had a big drag here on the broader market. You're looking at the weekly move on the 10-year yield. That's up 15 basis points, not the direction it wanted to go. And that's a big part of the reason why you see the red at the top of your screen. Strength in the dollar and phenomenal strength in gold. Remember, earlier this week, we hit yet another record high on spot gold on a weekly basis, up 0.8%, 27.43, Scarlett, and a lot of people think that could go even higher.
Yeah, absolutely. And although very curious that you have the dollar and gold rising at the same time, they tend to move in opposition. Let's just zero in on big movers of the day, and I want to start with Western Digital. It's a hard disk drive maker, closing at a 3-month high right now because the company reported quarterly earnings that beat analyst estimates. The NAND flash memory business holding up better than feared, according to analysts. And McDonald's, the worst performer in the Dow Industrials, losing about 3% today, according to the CDC. The outbreak of E. coli linked to McDonald's Quarter Pounders has spread. It's now infected 75 people across 13 states, so the actual number may be higher than what has been officially reported so far. Its supplier has pulled Quarter Pounders from 1/5 of U.S. stores of McDonald's. Now, our top story for this hour is the housing affordability crisis in the U.S. And the dynamic here is pretty simple. There's a ton of pent-up demand and nowhere near enough supply. And it's culminated to become one of the central issues of the 2024 presidential race. Each candidate has proposed his or her solution, while entrepreneurs attempt to use technology to accelerate construction. We're going to dig into all of that later on in the program.
All right, before we do that here, we do want to take a look back here at the week that was and some of the big factors that moved the market. Chris Cain of Bloomberg Intelligence joining us right now for our Factor Friday segment. This is actually my favorite segment of the week, by the way, Chris. And let's just talk about kind of what moved the market. We've talked a lot about momentum, but now I'm told there's something called fundamental momentum, or at least you've been looking into this concept of fundamental momentum. Explain that. What are you learning?
Yeah, so fundamental momentum, it certainly is not, a traditional factor, like people don't use fundamental momentum very heavily, but I do think it's really interesting. So, similar to price momentum, which is much more popular, we use the change in fundamentals. So we look at things like change in EPS over the trailing year to 3 years, change in net income, change in revenues, and we form portfolios based on that. That has worked decently well. Now, some stuff works better than others. So high EPS momentum specifically has worked a lot better than low beat it by about 100% since 2010. High net income momentum has worked as well, beat low net income momentum by about 40%. Revenues, not so much. It was about the same performance between high and low. So really the takeaway is that fundamental momentum is interesting. It potentially might work, but you really should focus on those bottom line metrics like EPS. Seems to work a lot better.
Okay, so focus on fundamentals first of all before you factor in the momentum. But if you look at fundamental momentum as a factor, I'm curious as to what traditional equity factor it's most similar to.
Yes, Scarlett. I mean, this is like, once you find maybe a non-traditional factor, really the next step is what correlations are they to traditional factors? Is this going to add value to my portfolio? When you look at the traditional factors, fundamental momentum is very much like quality. It has the highest correlation to quality, about 0.8 correlated since 2010. Price momentum is also very correlated, about 0.6. Low volatility, not so much. A big negative correlation though with value, as you would kind of, it's kind of logical when you think about that, about minus 0.6 correlated to value. So that's really the negative correlation. Really the key takeaway is that combining fundamental momentum and value could add a lot of value, no pun intended, whereas combining fundamental momentum and something like quality, not so much.
I like this conversation because we've had a lot of guests come on talk about how they're in search of value effectively, and some saying they're having a hard time finding it. But you have to kind of get a little bit more creative. Talk about this idea of EPS momentum fundamentals, I should say, and how that correlates with the stuff that you were just talking about there.
Sure. So like I said, long term, it's negative correlation between long short value and fundamental momentum. But right now is kind of interesting. The high fundamental momentum group actually has a very similar valuation to the market overall. It looks at median price to sales of about 3.09 versus 3.05 for the S&P 500. Typically it's much more expensive. Right now it's only 1% more expensive. It's average about 24% more expensive. So right now is kind of an interesting place where the high EPS momentum stocks are actually not overly expensive, which is an interesting thing to see.
Not overly expensive is certainly music to some investors' ears. Chris Cain of Bloomberg Intelligence, thank you. Have a great weekend. Coming up, the housing tide may be turning, at least according to new data. Eric Van Nostrand, chief economist at the U.S. Treasury, joins us next to discuss. This is The Close on Bloomberg. Prospective homebuyers may be starting to gain a little bit of an edge, at least according to Bloomberg Economics. New data show that more homes are selling below their list prices, largely in the South, and that would certainly be an encouraging development for those waiting for an entry point into home ownership. Joining us now to take a deeper dive into the housing market crisis, the affordability crisis overall, is Eric Van Nostrand. He is chief economist over at the Treasury Department. Eric, good to see you.
Good to be with you guys.
So we talk a lot about the presidential candidates and their proposed solutions to addressing housing affordability. They've each come up with a couple very specific policy proposals. Does it make sense to give a federal response when we know that housing is so dictated by local policies?
It's an important question, Scarlett, and I think it's important to start on the broad context for how we think about that federal response. We're sitting here at the end of 2024 in an economy that, as the Economist wrote on their cover this week, is the envy of the world, with historically low unemployment and inflation back to pre-pandemic levels. That combination gives us an opportunity as federal policymakers to tackle the long-standing challenges that have made costs too high for Americans. Over the past 2 decades, we've seen housing prices for renters and homeowners alike grow faster than their incomes. And as you cited up front, that's because we just don't have enough supply in this country. We have been building far too few homes for far too long. And it requires a partnership of not just the federal government and state and local governments, but also the private sector to ensure that we're building enough supply to keep costs low for American families.
It also involves the financing side as well, because mortgage financing perhaps is not accessible to a large swath of Americans who, by any other measure, should be able to buy a big ticket item. What can be done at a federal level to address that?
So one of the Biden-Harris administration's main focus on expanding housing supply is to expand it for the lowest income Americans, for the families and communities in this country that are facing the biggest challenges from costs that are too high. So we've called on Congress to expand the low-income housing tax credit. That's supply-side policy that makes it easier to build low-income housing. Just this week, Secretary Yellen, my boss, announced $250 million from the Treasury's Community Development Financial Institutions Fund to sending it to 48 housing finance institutions to build low-income affordable housing. These federal dollars are really important, but it's also going to take partnership with local governments.
When we talk about building that low-income affordable housing, are we talking about housing to own or housing to rent?
This challenge and the solutions oriented around it really span and affect homeowners and renters alike. The housing supply shortage is big enough that it's really grabbing both renters and homeowners. And we need to encourage cheaper housing construction to help both renters and homeowners.
But on the home ownership standpoint, and this is, I'm talking more from an economic perspective, and we think what's going to give us more juice. There has been at least conventional economic theory that home ownership provides a bit more of that than folks who rent, for example. And I am curious as to where that balance, where you're going to find that balance between home ownership levels and those folks who maybe are in a better position to just rent.
So I think you're right, Romaine, that increasing home ownership and encouraging getting that opportunity to families helps families save, helps get exposure to economic growth overall. But
generational growth.
Generational, exactly. But our housing shortage is big enough right now that we need to be throwing all hoses at rent to get housing to make sure we're growing this. One of the challenges we're seeing in particular, and this affects both housing to sell and housing to rent, is that we're seeing too much not in my backyard attitude at the state and local level, too much NIMBY attitude that is preventing the construction of low-income housing. That needs to stop because that's keeping housing costs too high for American families.
Most people agree, unless it's in their backyard, and then it's going back to NIMBY. So that raises the question, to what extent, well, let's put it this way. Accessory dwelling units have become a very popular thing, and that's kind of like cropped up as it feels like an ad hoc solution, not as a real institutional solution or as a federal policy solution. Is there a way to think about how to regulate that so that it makes more sense and allows housing to develop in a more organized way, as opposed to kind of just cropping up left, right, and center until people get fed up and start to come back to this not in my backyard idea?
Yeah, so I think the right way to think about the housing challenge is that it's a long-term problem that's going to require a long-term solution, not temporary solutions. So that means we need to change the structural challenge we've had over the past couple decades that are preventing not just some easing of short-term living spaces in certain communities where it's gotten too tight, but an attitude among governments across the country that adding to the housing supply is somehow counterproductive for American growth. That's not right. We need more.
But let's also talk about the participation in that potential growth. We've talked with a lot of folks on this program, real estate investors, a lot of whom are buying up single-family homes, even helping to build new single-family homes in interest of renting them out. Some of those people have been vilified, saying basically you're just taking homes away from would-be homeowners, primary homeowners here. Is there a policy in place at the Treasury right now, or at least one being debated, to address that issue, or is that not something you think needs to be addressed?
Well, here's how we think about it. We think that it's the Biden-Harris administration's view in general that we're a long way from a point at which we can afford to be too picky and choosy about what kinds of new housing we build. What we want to do is make it easier to build housing up and down the income distribution. And that's going to flow through and affect the low-income families the quickest. They're the ones that are going to benefit from the tax credits that are already in place, that we're calling on Congress to expand, and they're the ones that are going to benefit from our investments in some left-behind communities in this country to expand access where it's needed most.
All right, Eric, I really appreciate getting your views here today. Eric Van Nostrand, he is the chief economist over at the U.S. Treasury Department. A conversation about affordable housing and the potential here to maybe increase the housing supply in this nation. We had that conversation with one of the investors in that space. His name is Sean Dobson. He runs a company called Amherst, and he shared his take on the health of the housing market. Take a listen.
So in most of the markets we're involved in, the supply of homes for rent is actually above where it was pre-COVID, which is very different than the for sale market, which we still see down about 25-30%. Now the for sale market has grown quite a bit. We're up about a third from the bottom. And these are big moves for such a big asset class to have supply fall by 40% and then now rise by about 25 or 30% in the last 6 to 8 months. So we're seeing a little bit of what we would call a normal market, where the pace of sales is about what it was pre-COVID. The supply is coming, not restored, but coming back up. And then we're seeing in the rental market that rent growth is normalizing too. Rent growth is sort of steadily around the 3% range in the metrics that we watch, are sort of the live markets. And I know that the Fed is watching the sort of the realized rents, which are lagging even more. But what we're seeing overall in housing is, I would just say, a big decrease in volatility and the big wave of volatility getting further behind us.
So when we talk about housing and affordability, I know each presidential candidate has their own proposal to solve that, specifically by addressing the supply shortage, whether it's to buy or to rent, when demand really is not in question here.
Right.
Does it make sense to come up with a one-size-fits-all federal response?
Housing hasn't gotten the attention that it needs to get. We're 15 years post-financial crisis, and I spent a lot of time in Washington trying to prevent exactly what's happened, which is there's a trapdoor in the United States around housing. If you miss a couple of credit card payments, if you miss a medical bill payment, if you miss a student loan payment, if you miss a rent payment, a car payment, 2 or 3 of those missed payments, your credit score plummets. And Americans don't really know the formula for how that's all correlated. But the United States, post-financial crisis, we shut down what was called the subprime mortgage market, and we basically just shut the door on homeownership for tens of millions of Americans. The reason that we built our single-family rental platform was to serve exactly those families that were left out of the mortgage market. So the one-size-fits-all of, like, let's build more homes, it will help some people. Let's give a $25,000 down payment. It will help some people, but it won't create really any change in the housing market. These are very small subsets of people. Imagine the $25,000 down payment. The group of would-be homeowners that are only missing the $25,000 is a very small subset. That means they have the free cash flow, they have the credit score, they have the income, but they just haven't saved that $25,000 yet. That's going to help some people, and I'm all for it, but it's not going to move the needle. Building more homes is also not going to move the needle. If you add another 1.5 million units, where you're going to build those homes is out in the periphery of these cities. So putting homes out there that are another 30, 45, 50 minutes from jobs isn't going to make a difference. What will make the difference is lowering the bar of access to credit, giving that second chance mortgage to someone who has a credit score that's not perfect. But the average American has a 700 FICO score, and they're locked out.
But how do you do that without running into the same pitfalls that led us to the housing crisis? Because remember, the Bush administration, and really this kind of outgrowth of the Clinton administration, this was their gigantic plan. The idea was you lower the bar just a little bit, you get people in the door, and of course, to a certain extent, that backfired.
Yeah. Well, how you do it is you go back to what subprime was in 1998, 1999, 2000, which was a collection of borrowers who paid a little bit higher interest rate than the average rate to compensate for the credit risk of that pool of borrowers. And even in the worst of times, 2/3 to 80% of those loans worked out. But what happened in 2000, and we were on the front lines of the 2009 crisis because we were out, waving the flag that something was broken in 2006. But that special case had a lot more to do with fraud on behalf of the mortgage lenders and the mortgage borrowers than it did with just someone who has a lower credit score and has a slightly higher probability of risk. But our solution works for these families. And I think when I hear Vice President Harris or I hear the vice presidential candidate on the other side talk about housing, I get excited that we're finally going to get some reform. And it's going to have to be mortgage reform. Nothing else will work.
Thanks again to Sean Dobson. He is CEO, Chairman, and CIO of Amherst on our discussion on housing. I think about housing and how it's so much a part of our culture, and everything revolves around it in pop culture. Think of all the housing renovation shows. Think of all the commercials that featured mortgage rates and these great deals that you can get.
Yeah, I'm pretty sure I single-handedly kept HGTV on the air over the years here. But it gets to the idea too of like what's sort of new out there, right? And I think Sean Dobson at Amherst is trying to do new and creative things in the way you buy and sell homes. And a lot of people are also out there trying to do creative things in the way you build homes these days.
Right, absolutely. And that includes incorporating things like AI and technology. So let's go now to our next up segment, where we highlight the entrepreneurs and trendsetters who are moving the needle in the markets, technology, and venture capital space. And as we continue on this housing theme, this week we are spotlighting Togal.AI. This is a company that provides planning software widely used by housing and construction companies. Through the use of Togal.AI's software, they help companies save time and money by expediting pre-construction tasks. Joining us now to discuss this is the CEO of Togal.AI, Patrick Murphy. Patrick, thank you for joining us on The Close. Talk us through what exactly this software does and who it benefits.
Yeah, so this primarily benefits your builders and your subcontractors, because the way the workflow is today, if you're going to build a new house, as your guest mentioned, or any building, you basically submit those plans to 3, 4, maybe 5 different builders, and then those builders go to numerous subcontractors to get bids. Well, how do they get a bid? They have to quantify everything that is in the building, how much drywall, how much paint, how many doors and windows, etc. And to do that, it's a manual process today, either using a mouse or a scale ruler. So we had the idea to use artificial intelligence to automate that process. So you upload the plans, cloud-based software, click a button, within seconds, you're getting all of the quantities in a set of plans. So you're taking days, weeks, months of work, compressing it down to seconds, and doing it with greater accuracy. So it's a big leap forward for construction, because this is a process that's repeated over and over, because it's never just one plan, right? There's always revisions. There's always, more and more people bidding on a job.
And is this for residential, or is this for commercial property, or can it be applied to both?
To both, yeah. Any vertical building, quite frankly, we can process. And we've labeled tens and now hundreds of thousands of plans in a very unique manner. And this is, really one of the kind of issues with construction is the fact that it's antiquated, right? There's been numerous studies. McKinsey did one that showed that over the last 50 years, the productivity has remained flat. In some cases, actually gone down in 50 years. So we have to start innovating. We have to bring new technologies. And there's a lot of nuance. There's a lot of detail in construction. So things like AI, now that's in the market, that's now affordable, is able to process this information, the sheer amount of labeling we had to do. It took about 3 years to do the labeling.
Well, Patrick, in terms of scaling up this business specifically, in a sector that to a certain extent is somewhat fragmented, and not just fragmented in terms of types of companies, but fragmented on a geographic basis as well here, how do you bridge that gap in that fragmentation with something like this that, not saying it's one size fits all, but certainly provides a little bit more blanket approach?
Great question, and two approaches to that. Number one, since we are web-based, we have a collaboration tool where anybody can share their plans and see it live, just like you would on, say, Google Sheets, and everyone has different permissions. So whether that's the architect, the engineer, or hundreds of subcontractors that are often on a job, all seeing this information live. So that fragmentation all comes home to one place instead of emailing it. Number two is really, I think, the essence of your point, which is everything that's built is basically unique, right? Every building you see is kind of one of a kind. Imagine if every time you had to, take your car out, you had to design it, figure out the, size of the engine, the fuel tank, the electric, everything else. It wouldn't be feasible. But that's what we do in construction. We start from scratch every time. I believe in the next 5 years in construction, if you want to build a new building, you're going to have 3 inputs. You're going to input your address, your budget, and the style of construction, and you're going to get a full set of working construction documents in a matter of seconds. And this is the plumbing, the electric, the structure, the entire plan. And now you're taking a year or so of pre-construction and compressing that down to seconds.
I am curious too, and I do want to just draw on your past relatively short career that you had in Congress. You understand how Washington works. You understand policy, public policy specifically. How much is public policy needed, whether at the federal level or at the state and local level, to sort of address some of the issues that you're talking about today?
It has to be addressed, and I am glad to hear both presidential candidates talking about it and putting some new plans forward. Home ownership is part of the American dream, but it's disappearing for far too many people. We have to make it more affordable. We have to let more people get into that home ownership. And the rising cost of insurance, in my state of Florida, we just had 2 devastating hurricanes hit us. I'm sure insurance is going to go up again with continuing climate disasters. It's getting tougher and tougher, not to mention the fact land and construction costs are going up. So we need technology, and Congress and policymakers can do a lot to address this.
All right, Patrick, great stuff here, and we wish you the best of luck, and hopefully you'll check back in with us soon to give us an update on how the business is going. Our next up segment here with the CEO of Togal.AI, Patrick Murphy.
You know, I was just looking online, and one of the first things that someone posted in Reddit about Togal.AI or anything that proposes a technological solution is this going to take over our jobs? Is this something that's going to leave us obsolete?
About that. Yeah.
It's a valid
fair question. Yeah.
All right, let's take a look at
I ask myself that question every day.
I know. As do I. Yeah. All right, let's take a look at how markets closed on the day. Maybe the robot can take over for us saying that it was unchanged for the S&P.
No, we need to do that. Only humans can do that. But look at the disparity here, because we talk about the flat day on the S&P 500, flat week as well. And then you look at the outperformance that we saw in the Mag 7 in some of those big cap tech names.
Yeah, and it comes back to this idea that the growth stocks are showing earnings growth, whereas the value stocks haven't really closed that earnings gap, at least when you look forward 3-4 quarters with the growth stocks.
Yeah, hard to say where markets are going to go next week, but I think one thing is almost certain. Expect a little bit more volatility, of course, with a huge slate of earnings, some key economic data, and of course the wind-up to the U.S. election.
This is The Close on Bloomberg.
All right, we're about 2 months away from the U.S. Space Force's 5th anniversary, if you can believe it. And ahead of that milestone, the newest branch of the U.S. military is continuing to hit its recruiting goals. But it does say that long-term it will need more help to find a big enough pool of young would-be space guardians with expertise in things like cyber operations, geospatial intelligence, and astronautical engineering. And that's shifting the focus of the educational system as well, to focus more on the hard sciences, from grammar schools all the way up through college. Our next guest was a NASA engineer at the Ames Research Center before devoting her career full-time to furthering STEM education. She runs the advisory firm STEM Board and the ed tech company Lingo, and is scheduled to go to space soon on Blue Origin's new Shepard rocket. Pleased to say that Aisha Bowe joins us right now, the founder and CEO of STEM Board and Lingo. Lingo just closing a new seed round, roughly $2.5 million. Thanks for being here.
It's great to be here, Romain.
Let's talk about this idea of having a broader and maybe a deeper understanding of STEM education. There's been a big push over the last few years, but we've heard from so many different industries, whether it's space, whether it's AI, whether it's chips, everything else, that if the U.S. is going to be dominant in those areas, we need more young people studying that stuff now.
I couldn't agree more. I say often that I may be considered to be one of few, but my goal is to be one of many. And that starts with hands-on project-based learning. I didn't decide to pursue this career until I was 18. And at that time, I wasn't thinking about space. I wasn't thinking about science. I was just thinking about how I was going to get some meaningful employment. But what I realized was that space, engineering, science, not only was it something that was tangible, it was the gateway to a career field that I loved.
What does that look like, though, for other kids out there? I mean, it's interesting. I didn't realize that you didn't really have an interest until 18, which sounds late if you want to become, basically a rocket scientist, or more or less here. But that seems to suggest that it's not too late, that if you somehow don't get that education in grade school or even in high school, you can still do it. Is that true?
That's true. Yeah. And that's what motivated me to found Lingo. What I realized was that there was this prevailing perception that if you were not exposed to STEM early, you would not be interested. But I'm living proof that not only is that not true, you can be successful.
And just to be clear for our viewers, basically what you're selling with Lingo, it's almost like a kit, right? That parents, assumably parents, would buy for their children, right?
What's amazing about Lingo is that we augment what's available in traditional education. Our kits are self-paced, they're self-guided, but they're also aligned to national curriculum standard, which means that they can be taught in schools. Today, we've served over 10,000 students. We've been delivered in nearly 10 countries, and we're working with schools, nonprofits, and corporations all over the country to provide the skills like aerospace engineering, geospatial, through our lessons, which our engineers develop in-house.
And how do you measure the success of that or the effectiveness of that? What do you want to see these kids move on to do through the use of these Lingo kits?
We measure our success in several different ways. The first part is impact and also our footprint. We started in 3 schools in East St. Louis. We're in 17. We're in Denver. We're in Tampa. We're working with industry leaders like General Dynamics, Siemens Healthineers, and Logitech even did an entire documentary on teaching how to make a rocket launch countdown timer to students in Nairobi. We know that it works. Our team, not only myself, but those who lead Lingo, are the evidence of this. We are not only engineers who are operating in the field, but we're able to take what it is that we've learned and translate that into students who are aspiring and doing the same.
That early exposure sounds wonderful, but I wonder how students can supplement that with practical experience, because that's something that needs to be reinforced over time. Otherwise, it just becomes kind of theoretical to them.
Yeah, and you nailed it. And that's why the industry partnerships we have are so important. A student may come and have a Lingo course, and then you know what we do? We partner with these tech companies to provide pathways to internships. I had the pleasure of being not only a partner to General Dynamics, but watching them offer opportunities to students to come and to study and to also work with them later on. And they're not alone. We're seeing that industry-leading companies are partnering with organizations like ours in order to make these career paths accessible.
When we talk about the build-out of Lingo into whatever it's going to scale up to be here, do you anticipate that that build-out is going to include more partnerships like the ones you had with General Dynamics? I know I've read in the past that you did some work with SpaceX as well on this same topic here. Is that kind of the future? We should be looking to some of those names?
We're really proud to say that we're backed by a bunch of tech companies who have the same vision, mission, and values as we do. We partner with them because we're providing education that bridges the gap between what students may be exposed to in a college environment and the practical skills that need to learn in order to be successful in careers or decide to pursue those careers.
Now, of course, you have 6 years of experience as a NASA rocket scientist. You will be traveling to space with Blue Origin at some point. I'm curious to see how you see Lingo fitting in with where you see the space industry going, especially with more of the private sector taking up, the development, the innovation, and the advancement of that industry.
One of the latest lessons from Lingo, of which we have 2, is a rocket launch countdown timer. The plan for Lingo is when I go to space, that students around the world go to space with me. They will actually be able to build this countdown timer and launch themselves alongside with me. But it doesn't stop there. We also have a small spacecraft lesson where we're teaching students how to build small satellites that are capable of Earth monitoring. Where have you heard about that being done in high school? That is what we're bringing not only to the United States, but to the wider world that is interested in participating in commercial space.
Well, what do you think of the broader future? This is a bit of an esoteric question, but I mean, we talk about, I came of age at a time, it's kind of right when the space shuttle program was getting going, and obviously a lot's changed since then. Scarlett was referencing all the private launches we have today. Do you envision kind of a world, and it might be long after we're gone from this earth, where just regular people will have access to space in some way, whether it's going up there for tourism or for some more practical purpose? Is that going to be common?
I believe so. You're looking at what I would consider to be a regular person, myself, who's getting access to space. This mission has been made possible. You are a rocket scientist. When I say regular people, I'm talking like pedestrians like me and Scarlett who didn't study in the hard sciences. I understand that, but I came to this path after not knowing what it was that I was going to do. I'm a community college student that went to an aerospace school, that founded a tech company, that ran it for 11 years, and then decided that I was going to go and raise venture capital so that I could be on this mission.
All right. Well, Aisha, it's a great story and really fascinating subject overall. And of course, we'll be keeping an eye on you right here on Earth and maybe at some point in the future up there in space. Aisha Bowe, founder and CEO of Lingo and STEM Board here as we take a closer look here at space, which is getting a lot closer to us, I feel.
It is. I mean, you think about Elon Musk and his plans to populate Mars and, just the kinds of things we're talking about now were unthinkable when you and I were kids.
Yeah, it was all just completely science fiction. I mean, I would read about it in, the Isaac Asimov books, but now it's like, it starts to look real, and I don't know, we might not get there in my lifetime, but it certainly feels like it's around the corner.
Or if you and I win the lottery, maybe we can go to space at some point.
I would. I asked my wife that the other day if somehow we could afford to go up there on one of these things. She said no way, and I said I would go, and she said, all right, nice knowing you.
Enjoy. All right, well, still ahead here on Earth, the Yankees and the Dodgers will be heading off against one another. That's not the right metaphor. Going head to head?
Head to head?
They're going head to head, yeah.
Bat to bat?
It is a matchup for the ages, and it starts tonight. We've got a former Yankee, Johnny Damon, joining us to tell us what he's looking for.
And former Red Sox.
Let's stick to former Yankee. This is Bloomberg. pitch of the 2024 World Series is tonight. The anticipated matchup between the New York Yankees and the LA Dodgers takes place tonight in Los Angeles. It is the first time the two have met in the World Series since 1981, and early signs are it could generate more than $70 million in additional ticket sales. Joining us now is someone with firsthand experience on competing in a championship series, Johnny Damon, former MLB player who won the World Series with the New York Yankees in 2009. Johnny is also the founder of energy drink brand A-Game. This is the matchup, Johnny, that MLB has been dreaming about, right? The New York Yankees versus the LA Dodgers. Last year's World Series was between the Diamondbacks and the Rangers, and it averaged about 9 million viewers a game. What are you thinking? What do you think MLB is anticipating for this matchup in terms of just scale and how much attention it could generate?
Yeah, we are definitely looking at a 7-game series. I mean, this is something that the whole world is going to pay attention to. You have two of the players who are going to be named MVP, Aaron Judge and Ohtani, two of the greatest players in our generation. The Yankees and Dodgers, they haven't met in the World Series for 43 years, and there's going to be a lot of eyes on this series for sure.
A lot of eyes as well. And you talk about this idea of how the network is leaning into, how Fox is going to lean into it. The ad dollars, of course, have already been sold out completely. And the idea of what that fan experience is going to look like on the field and how it's going to look to viewers as they're watching it.
Yeah, this is something that everyone's going to stop and pay attention to. All around the world, people know who the Yankees are, know who the Dodgers are. And the fact that Ohtani's from Japan, you're going to have all of Southeast Asia paying attention. I'm excited about it, and I don't get excited about too many things anymore. So this is fantastic.
It's also exciting for Juan Soto, who becomes a free agent during the offseason. As someone who has been in a similar situation, who understands the stakes of a championship series, what does a player think about in terms of preparing for a series that's really going to showcase his talents to a future employer or future employers?
Yeah, well, we all want Juan Soto to remain a Yankee because he fits in perfect with this team, with the lineup, with the city. I know the Mets and Stevie Cohen is going to make a strong pitch for him to stay in New York, but he knows what he's doing. He got caught up to the big leagues when he was 19 years old and just has been an absolute beast. And it's going to be a great series. And, I'm hoping the Yankees win. I know the Dodgers have some guys who can steal bases at a rapid pace. You have Ohtani, you have Mookie Betts, who, don't forget about him. He might be one of the best players in the league because he can play second base, center field, right field, hit for power, hit for average. And he's playing in Boston, a very tough market. I thought Boston was a tougher market to play in than playing in New York because the guys like Jeter and A-Rod, they got all the tough questions. So my questions were pretty easy. Why'd you lose today? Well, I didn't get a hit, when I needed to. So it was very easy. The fans respect the guys going out there, working their tails off. And I'm happy for Aaron Boone. It's been a long time coming. And I'm glad he's back in the World Series as a manager this time. And I know he does a great job at controlling that clubhouse, and I'm pulling for the Yankees for sure.
Of course you are. Johnny, in your mind, who's the underdog in this series and on what basis? Because you could look at it in terms of payroll, and the Dodgers have been kind of at the top there, or in terms of recent history where the Dodgers have done a much better job of getting to the postseason consistently. How do you think about that?
Well, both of these teams are in the World Series for a reason. They have the best players around. You do have to spend money to have the best players around and continue to spend money going forward in the future, and make sure that the money that you are spending is wisely. The players can live up to those contracts, because there's a lot of contracts that aren't good. And the Yankees really want Soto back, and it's going to come down to the amount of years he wants. Yeah. Granted, what is he, 25 years old? He can still get a 15-year contract if he really wants. And ultimately, the fact that Ohtani deferred a lot of his contract goes to show you how much money he is making off the field in endorsements. And he isn't just Major League Baseball in the U.S. endorsements. He's all around the world. And I would love to see how he very well can become a billionaire in a couple of years. So that's where the money is at in this game, the social media game, the internet game, all that stuff.
All right, Johnny, I think we have to leave it there. Really appreciate you taking time for us. Johnny Damon, of course, former New York Yankee and the founder of A-Game Beverages. Also, we should point out, Scarlett, former Boston Red Sox. I know that pains your heart.
Yeah, why do you have to keep adding that?
But he won his first World Series with the Red Sox,
But,
first championship since 1918.
I only know about the 2009
New York,
World
all you
Series.
New Yorkers, you like to steal everything for yourself here. He belongs to everyone.
I don't know. I don't quite agree with you there, but
all right,
we'll agree to disagree.
All right, well, the World Series is kicking off here. Let's real quickly get you through some of the other potential events over the next week here. We're going to get some earnings coming out on Monday, including from onsemi and Ford. Tuesday brings us some economic data, Scarlett.
Yeah, we've got the Conference Board Consumer Confidence. We also have JOLTS as part of the drumbeat to the big jobs report at the end of the week. But earnings-wise, we get McDonald's, we get Royal Caribbean, Chipotle, and AMD would be interesting given AI.
Yeah, we're going to get about a third of the S&P reporting next week. On Wednesday, we get more earnings as well out of a slew of companies, including Kraft Heinz, Eli Lilly, Meta, Microsoft, and DoorDash. Let's keep it going because Thursday is going to be a big day as well. Personal income in the morning and a big earnings report from two companies in the afternoon.
Apple and Amazon, and there's Intel and MasterCard as well.
Oh yeah, those two guys as well. And a big jobs report on Friday. All the setup here to what is going to be an election week after. Stick around. Balance of Power is up next.